In late January 2021, the financial world witnessed a spectacle that seemed straight out of a thriller movie. GameStop, a struggling video game retailer, suddenly became the center of attention, not for its products, but for a monumental clash between Wall Street giants and individual investors. What started as a Reddit-driven uprising against hedge funds soon snowballed into a global phenomenon, shaking the foundations of traditional finance and sending shockwaves through the stock market. As the story goes, a group of retail investors, organized primarily through a subreddit called WallStreetBets, discovered that several hedge funds had taken massive short positions on GameStop stock. Short selling, a common practice where investors bet against a stock's rise, was intended to profit from GameStop's expected decline. However, what followed was far from predictable. The Reddit group, driven by a mix of defiance against Wall Street norms and a desire to challenge financial elites, collectively bought GameStop shares en masse. This unexpected surge in buying activity caused the stock price to skyrocket exponentially, squeezing the hedge fund's short positions. The phenomenon drew global attention, sparking debates about market manipulation, the power of online communities, and the future of traditional finance in the digital age. Driven by a mixture of internet-fueled enthusiasm, defiance against financial elites, and a desire to stick it to the man, small investors began buying GameStop shares en masse. This coordinated buying spree, fueled by social media hype and meme culture, triggered a historic short squeeze, a scenario where rising stock prices forced short sellers to buy back shares, further driving up prices. This phenomenon, centered around a struggling video game retailer, became a symbol of retail investors challenging Wall Street norms. It highlighted the power of collective action facilitated by online platforms like Reddit's WallStreetBets, where individual investors exchange tips and rally behind stocks perceived to be undervalued. The resulting volatility drew attention to regulatory questions regarding market manipulation and the role of social media in financial markets. The mainstream media quickly picked up on the frenzy, with headlines blaring about Reddit traders and GameStop revolutionaries. Celebrities, politicians, and even Elon Musk chimed in, adding fuel to the fire. The stock price of GameStop soared from around $20 to an astonishing peak of over $480 within days, defying all traditional valuation metrics and confounding seasoned investors. This unprecedented surge was fueled by a wave of small investors on platforms like Reddit's WallStreetBets, who coordinated to buy GameStop shares en masse, targeting institutional investors betting against the stock. The Saga highlighted the power of social media in democratizing finance and challenging established Wall Street norms, prompting widespread debate about market manipulation, the role of hedge funds, and the future of online investing communities. As GameStop's stock price skyrocketed, the hedge funds that had bet against it faced catastrophic losses, reportedly in the billions. Melvin Capital, one of the primary targets of the short squeeze, had to be bailed out by other Wall Street firms to avoid bankruptcy. This David and Goliath narrative struck a chord with many who saw it as a rebuke of the financial establishment and a symbol of power shifting from Wall Street to Main Street. The event sparked widespread debate over market manipulation, regulatory oversight, and the democratization of investing. It also fueled discussions about the role of social media in driving market volatility and whether such movements represented a sustainable challenge to traditional financial power dynamics. Ultimately, it highlighted the complexities and risks inherent in modern financial markets, leaving lasting implications for both investors and regulators alike. The GameStop saga highlighted broader issues within financial markets, particularly concerning market manipulation, regulatory oversight, and the growing influence of social media on stock trading. Critics argued that the Reddit-driven frenzy was akin to gambling, driven by hype rather than fundamental analysis. Others saw it as a populist movement exposing the inherent risks and inequalities of Wall Street's financial gains. The event spurred debates on the democratization of investing, with retail investors challenging traditional financial institutions. It also underscored the need for updated regulations to address new dynamics in online trading platforms. Amid the chaos, trading platforms like Robinhood faced backlash for restricting purchases of GameStop and other volatile stocks, claiming it was to protect users and comply with capital requirements. This move further fueled accusations of favoritism towards institutional investors at the expense of retail traders, a stark reminder of the power dynamics at play in financial markets. The controversy highlighted how regulatory structures can disproportionately affect smaller investors, prompting calls for greater transparency and fairness in market operations. It also underscored the influence of social media on stock trading, where online communities can swiftly mobilize against perceived injustices within the financial system. The aftermath of the GameStop saga saw renewed scrutiny of short-selling practices, calls for tighter regulation of online trading platforms, and debates over market transparency. It prompted discussions about the democratization of finance and the role of social media in shaping market sentiment, an unprecedented intersection of technology, finance, and grassroots activism. This phenomenon highlighted the power of online communities to challenge traditional financial institutions and influence stock prices. It also underscored the volatility that can arise from retail investors banding together against institutional investors, raising questions about market stability and fairness. Moving forward, regulators face the challenge of balancing innovation and investor protection in a rapidly evolving landscape of digital finance. Beyond the immediate headlines, the GameStop phenomenon underscored broader economic tensions exacerbated by the COVID-19 pandemic. As millions faced job losses and financial uncertainty, the rapid rise and fall of GameStop stock symbolized both hope and disillusionment, a stark contrast between Wall Street's gains and Main Street's struggles. Looking ahead, the legacy of the GameStop saga remains uncertain. It sparked a wave of interest in stock trading among younger generations, fueled by platforms like Robinhood that make investing accessible to all. Yet, questions linger about the long-term impact on market stability, investor behavior, and regulatory responses to future market disruptions. As we reflect on the events that unfolded, the GameStop short squeeze serves as a cautionary tale and a testament to the power of collective action in an increasingly interconnected world. It challenges us to rethink the dynamics of financial markets, the ethics of speculation, and the resilience of traditional financial institutions in the face of digital disruption. Remember to like, share, comment, and subscribe to stay updated on more insightful content like this. Join the conversation on how the GameStop saga reshaped finance and what it means for the future of investing. Thank you for watching, and we'll see you in the next video.